evening, everyone. I'm the joint manager of the Baillie Gifford UK Growth Fund. We were fortunate to be awarded this mandate in the beginning of the year, in April, and I managed this together with my colleague Ian McCombie. And since we have gotten the assets, which was in the end of June, we have quite radically repositioned the portfolio, which now represents really a concentrated selection of what we think are some of the best UK growth companies which we intend to own over the next 5 to 10 years. For those who don't know, as a quick introduction, Baillie Gifford is an independent private partnership. We think there's some tangible benefits arising from that structure, and maybe if I have time, I'll come back to that point later on. We have 108 investors, all based in Edinburgh, looking for stocks across the globe. We are committed to a very long-term, highly active growth investment approach. Ian and I are part of a team of 7 specialist investors, UK equity investors in Baillie Gifford, and we look after about 5.7 billion of UK specialist assets. This is our flagship retail offering, and we're very excited about it. This is a snapshot of our investment philosophy. These are high-level principles that underpin the way we manage the trust, and we share those principles with the rest of our colleagues in Baillie Gifford. First and foremost, we are very long-term and very patient investors. We think this is our key advantage in the financial industry, which has become very short-term and very impatient. Our investment time horizon is 10 years. Our estimated portfolio is here given as less than 20%, but in fact, our institutional funds are closer to 5-7%. We are also strong proponents of the merits of active investment management, or the need to build portfolios which are very different from the benchmark in order to deliver good returns to clients over the long run. Active share is one such measure of differentiation and is very high at 87% for this trust. We are unashamedly growth investors. We are looking for companies that have the potential to become multiples of their current size during our long investment horizon. We have extremely low predictive powers when it comes to determining what share prices do in the short run, but we do believe that companies with above average growth in cash flows will over time be rewarded with superior share price performance. It probably looks all familiar. These are all the headlines and the buzzwords that are dominating what are currently very fearful and very jittery financial markets. For those of us living here in the UK, James spoke very eloquently about all the fear and panic surrounding Brexit negotiations. There's, of course, the spectre of a trade war between China and the US. People argue about the implications of interest rate increases. You probably hear and read a lot about these issues, so I didn't want to talk about them tonight. Tonight, I wanted to offer you a slightly different perspective, one I think you might find useful at some point or another. And it's a perspective that's really rooted in a simple observation, which is this relentless obsession of our industry with guessing the outcome of these big political and macroeconomic events can sometimes prevent us from appreciating a simple but I think quite fundamental fact about the nature of capitalism. And that fact might actually have the decisive bearing on the direction of equity markets over the long run. And the fact is that at its heart, capitalism still embodies a process of creative destruction, a ruthless Darwinian struggle in which some businesses prosper while others wither and disappear. And I know some of my colleagues go even further and argue that technological forces, driven, for instance, by the tremendous strides in computing power through the advances of Moore's law, are now serving to speed up this process of creative destruction. They are creating disruption in industries as different as retail and healthcare, energy and financial services. This is a slide, the chart comes from a well-known report by McKinsey, and it shows you the significant increase in the churn amongst the constituents of the S&P 500 index over a very long time frame. I'm cheating a little bit because it's clearly a US-centric slide, and I'm talking about UK equities. But the reason why I chose it was because of that very long-term perspective that it gives you. And I think in some ways you could see this chart as a proxy for intensifying competition. So if you are sympathetic to this viewpoint, I guess the question you then have to ask yourself as an investor is, what do companies that are faced with such inexorable trends do in order to survive? And I think, unfortunately, for me, the answer is that many public companies tend to respond in ways that are hindering rather than increasing their odds of success. And one way of illustrating that, I think, is this chart, which shows you the growing, quite meaningful and growing, divergence between the amount of cash flow that listed companies direct towards organic investment in CapEx and research and development, and the amount of cash flow they choose to return to shareholders in the form of buybacks and dividends. Indeed, I think many many companies, listed companies, have now become kind of addicted, really, to the short-term pop in their share prices, which is triggered by a share buyback announcement program. So much so that we see many of them taking on additional debt in order to be able to fund such programs. Now, clearly, we were talking about the importance of growing dividends, and I don't wish to argue there's anything wrong with returning money to shareholders in principle. But I think what this chart shows is that there is a clear danger that management teams have been sacrificing long-term investment in order to boost short-term profits and short-term share prices. That maybe they're listening too much to the demands of the financial community and not sufficiently to the voices of their customers or their employees. And this is the kind of behavior that is likely to make them a lot less capable of responding to the competitive assaults which will be thrown at them. Fortunately for us, I think not all public companies behave in this manner, and I hope to talk to you about a few that I don't think do that. We sort of intuitively know that stock market returns are asymmetric, they're skewed. And I think the recent work of Professor Hendrik Bessenbeider in the US has shown quite the extent to which this is the case. In the US market, in his sample of 25,000 companies over a 90-year period, the net positive returns of the market were generated by only 4% of the sample, which highlights this importance, which we're all aware of finding these multi-baggers or big winners. And that's the best, most rewarding part of our job. And I've listed a few characteristics which I think could guide us a little bit in this endeavor. But of those characteristics, I think the third one, this rather nebulous concept of corporate culture, is actually quite an important one. And it's important in the context of change and disruption, which I was just talking about. It is quite a challenging concept. It's probably the most challenging of them to get your head around. It's probably particularly challenging for people like me that work in the financial services industry, because we are used to measuring everything and putting numbers on everything, and culture is clearly intangible. It is not easily quantifiable. It is also the characteristics that, in all honesty, is the hardest to spot in advance. It's very easy to recognize it in hindsight, but much more difficult to spot it in advance. Having said that, I think all really, really successful companies tend to share a set of common cultural traits. And again, I've listed some of those. For me, the first one is by far the most important, is this unwavering focus on the long term that I already spoke about. And I think the emphasis here really should be on the word unwavering. I don't think I've ever met a corporate that has told me that they aren't long term. But I really do think that in practice, very few companies are uncompromising in their commitment to this. For most companies, weak trading and missing analyst expectations is, and they very quickly start to succumb to short-term pressures. Another trait which I think some of these big winners have is this strong identity. There's a very clear vision of what they're trying to achieve. It's a vision that extends well beyond the imperative to generate profits for shareholders. Quite often, this vision is about solving some big problems for customers. And these big winners know that the best way to do that is by nurturing and inspiring their own employees. So if in the short run, and that happens quite often, the interests of their shareholders start to conflict with the interests of their customers or employees, the latter camp always wins against the former. They also have a deep appreciation of the importance of change, the inevitability of it, and the need to reinvent yourself, to adapt, even when that feels very uncomfortable. So they focus on innovation, and they do it very consistently, day in and day out. And because I am a bottom-up stock picker, and I have no idea about macro, just as James said, I want to talk to you about 3 exceptional UK growth companies, in my opinion. companies which we hold in the BG UK Growth Fund, and we have held in our institutional portfolios for well over a decade. And these are companies we would like to hold on for the next decade or even beyond. And the main reason why we do that is because we do believe that they have these cultural attributes in spades. Their cultures have been very important in their success, and we think they will continue to help them unlock new opportunities, but also to adapt to disruptive changes. And the first one is very close to my heart. It's a company called Renishaw. It's based in Gloucestershire, and it is a manufacturer of high-precision measurement, motion control, and sensing equipment. Basically, you're unlikely to have ever been on an aircraft or driven a car where one component hasn't been touched by these highly accurate probes, this probe that we have here on the picture. They also make encoders, which are miniature feedback positioning devices that people use very widely in robotics and in semiconductor manufacture. And Renishaw is a very unusual company in many respects. I think quite superficially, it's unusual in the sense that it is a rare example of a truly world-leading engineering business. I mean, we talked about Rolls, and that's another example of that. But in this field of tactile metrology that these guys specialize in, they practically have no effective global competition. And the reason for that competitive strength, well, one of the reasons for that competitive strength has been just decades of sustained commitment to very high levels of research and development spending. This company has spent for decades about 15-16% of its sales on R&D, and it is a highly unusual thing for an engineering industrial company to do. It's the kind of spending that we would expect from a pharmaceutical, from a technology company. What's also unusual is how firmly committed they are to being a vertically integrated manufacturer. You know, most industrial companies I meet, regardless of their size and the sector that they operate in, tend to view manufacturing as a cost center. You know, it's something that you outsource to other people, preferably in a low-cost geography. Whereas these guys really believe in the merits of their vertically integrated, highly automated manufacturing in the UK. I was talking about the importance of prioritizing the needs of your customers and employees. I've seen very few companies that do this as well as Renishaw do. They realize that how difficult it is to find engineering talent in this country. So they really take great care of their existing employees. Their staff turnover is exceptionally low. But they also have a lot of efforts all the way from primary schools to very generous PhD sponsorships, which are aimed at finding the talent of tomorrow. But the thing that has always impressed me with Renishaw is the consistency with which they do these things. They would invest in their business and in their customers and in their people, regardless of what the external environment looks like. The often substantial volatility of their share price also has absolutely no bearing on their actions. It's a very admirable long-term attitude, and one that has been nurtured by their founders, who still hold over half of the shares. And it's a culture that also has nurtured a great focus on innovation and reinvention. I was talking about the importance of that in the context of disruption. Because Renishaw continues to have a very significant opportunity in its core business, from increasing penetration of automation in global manufacturing. But it has been innovating in completely new areas, neurosurgical robotics, but also very importantly, metal 3D printing. And that's an important one. Metal 3D printing, additive manufacturing in general, has the potential to disrupt a lot of manufacturing processes in the long run. And a lot of those processes would employ Renishaw equipment at some stage. So this company has the foresight to invest very aggressively in something that could threaten its business. In fact, I think they're likely to emerge as one of the world leaders in this area as well. And if they do, success will be very transformational for their financial performance over the next decade and beyond. Genus is also a company that has innovation very much at the backbone of its culture. It's an animal genetics company. It has a very attractive growth opportunity from just the fact that global populations are growing, becoming wealthier, and that tends to be associated with increased use of animal protein. But what it also tends to be associated with is a sustainable burden on the resources of our planet, our water, land. So farmers have to look for ways to cope with this increased demand in a lot more sustainable manner. And this is what these guys enable them to do through genetic improvement technology. And I've always been impressed of how dedicated they are to continuous improvement. They deliver small incremental innovations to increase their customers' productivity every year. But the reason why I'm becoming particularly excited about this company at the moment is because now it's starting to invest in some radical innovation. It's doing this mostly in its porcine business, where it is trying to find a solution to something called PRRSV, which is the porcine respiratory reproductive syndrome. It's a very devastating disease which wipes off billions of farmers' profits from in the global pork industry, and there's no cure for it. So what they're trying to do is they're employing something called gene editing, which is a quite immature but highly prospective technology, which enables edits to be made to the genome. In this case, they're silencing the gene which is responsible for this deadly virus, and they're trying to breed pigs that are resistant to it. If they succeed, it'll be hugely beneficial for their customers. I'm running out of time, as I suspect I would be. When I talk about my stocks, it happens quite a lot. This one is a funny one, because it is really, when you talk about sort of strong identity and vision, I think this one really fits the bill. It's a very quirky, unusual retailer, Ted Baker. It's the alter ego of an entrepreneur called Ray Calvin. And he's been on quite the journey since he was founded about 30 years ago in Glasgow as a single shirt specialist shop. And now they've really become this global lifestyle brand that people everywhere, stylish people, men and women, like to wear. And I like it because there's a lot of panic at the moment. I would argue quite indiscriminate panic in anything to do with retail, and it's understandable why. I mean, one of the big disruption sort of things that have happened over the last decade or more, and we can all relate to it, has been the rise of e-commerce, online shopping, right? So in stock markets, that has basically caused a very severe contraction in the multiples that people were willing to attach to companies that are perceived as traditional retailers. But I think it also gives huge opportunities to investors that can identify the very few companies that are able to adapt to the change. And in my view, Ted Baker is definitely one of those companies. And the reason for that goes back to this issue of culture. It's a strong identity, which inspires a very differentiated product, great storytelling, but also it's been a very measured approach to growth. Unlike many other retailers, this company has never really succumbed to the temptation to pursue growth for its own sake. They have grown in a way that puts the priority on an organic development of the brand, on getting repeat customers, not just rolling out stores to please shareholders. And the companies that are struggling a lot at the moment are those that have pursued undisciplined growth, those that have done the opposite of that. These guys are a lot more nimble at the moment in how they're adapting to the changes afoot. They have a already quite a sizable and profitable and very fast-growing online operation. They're using technology in a very effective way, I think, to become even better at communicating with their customers. They did a movie with Guy Ritchie recently, which is a shoppable movie. I don't think there's been many of those done before. And they did a collaboration with Google in augmented reality in a very successful campaign called Keeping Up with the Bakers. But these reasons are, for me, important because they make me think that this brand has what it takes to thrive, both in the UK and abroad in the next 15 years, hopefully the next 15 years when we own it. This is just a slide to show that these three companies are by no means isolated examples. 54% of the portfolio is invested in companies which we together as a team have held for over 10 years. And to conclude, well, what's the reason that I think we stand a chance of finding some of the very successful UK companies of tomorrow and of doing a good job for our shareholders? I think, again, the main reason goes back to culture. Like the companies I've just discussed, what we try our very best is to stay really focused on the long run. It's to prioritize the needs of our own clients and also to be a helpful influence on the companies we support. And for us, that's really made possible by our partnership structure, which gives us an independence and stability. So with that, I will conclude and happy to take your questions later on.